Let me ask you something. What if the strategy you've been told will make your retirement money last forever is actually one of the worst ones you could use? And what if a brand new study just proved it with data going back over 100 years? Because that's exactly what Morningstar did. They ran a deep, rigorous analysis comparing 8 different retirement withdrawal strategies head to head, and the results genuinely surprised me. Some of the most popular advice out there didn't hold up, and some of the lesser-known strategies, they crushed it. So today we're breaking down all 8 of them, what they actually mean, how they performed, and which one might be the right fit for your retirement. Stay with me, because by the end of this video, you're going to see retirement income planning in a completely different way. Before we get into the strategies, let me give you just a little bit of context so everything makes sense. Morningstar's research team, led by Christine Benz, looked at how retirees should think about drawing down their portfolios without running out of money. The big fear in retirement, the one that keeps people up at night, is called sequence of returns risk. That's the risk that you hit a bad market early in retirement, sell assets at a loss to cover living expenses, and then never recover. It's brutal, and it's real. So the question these researchers asked was simple but incredibly important. Of all the strategies out there for withdrawing money in retirement, which ones actually protect you against that risk while still letting you spend enough to live your life? They tested these strategies over rolling historical periods and also ran thousands of Monte Carlo simulations, which are basically computerized stress tests that throw every possible market scenario at your portfolio. And they landed on 8 distinct strategies. Let's go through every single one. The first strategy is the one almost everyone has heard of, the 4% rule. The idea is simple. In your first year of retirement, you withdraw 4% of your portfolio. Then every year after that, you adjust that dollar amount for inflation, regardless of what the market does. So if you retire with $1 million, you take $40,000 in year 1. If inflation runs at 3% the following year, you take $41,200 in year 2, and so on. The beauty of this rule is its simplicity. You don't have to think about it. You don't have to monitor the market. You just follow the formula. But here's the problem Morningstar found. In today's environment of lower expected returns and higher inflation, the original 4% rule may actually be too aggressive. Their updated research suggests something closer to 3.3 to 3.7% is safer for a 30-year retirement horizon with a balanced portfolio. The 4% rule was built on historical data from a more favorable period. It's not dead, but you need to understand its limitations. The second strategy is called the dynamic spending rule, or sometimes referred to as the guardrails approach. This one is more flexible and honestly a lot more realistic. Instead of blindly increasing your withdrawals every year for inflation, you adjust them based on what your portfolio is actually doing. You set an upper and lower guardrail. If your portfolio grows enough that your withdrawal rate drops significantly below your target, you give yourself a raise. But if the market tanks and your withdrawal rate creeps too high, you cut your spending by a set percentage. Morningstar found this approach significantly improves sustainability because you're responding to reality rather than ignoring it. The trade-off is that it requires more discipline and monitoring, and it means some years you might have to tighten your belt. But for most people, that flexibility is actually very manageable in practice. The third strategy is the fixed percentage withdrawal. This is even simpler than the 4% rule in one sense. You just always withdraw the same percentage of whatever your portfolio is worth at the start of each year. So if the market was great and your portfolio grew, you get to spend more. If the market dropped, you spend less. This sounds painful when markets crash, but here's what Morningstar found. This approach virtually eliminates the risk of running out of money because your withdrawals automatically shrink during downturns. The downside is income volatility. You may go through periods where your spending drops significantly, which makes budgeting really hard. This works best for people who have a pension, Social Security, or some other stable income floor that covers their basic needs. And the portfolio withdrawals are more for discretionary spending. The fourth strategy is one of my favorites conceptually. It's called the floor and upside approach, or sometimes the bucket strategy in broader terms. The idea here is that you separate your money into 2 buckets. The first bucket holds enough in safe, stable assets, things like bonds, CDs, or annuities, to cover your essential living expenses for a set number of years, maybe 5 to 10. The second bucket is invested in growth assets like equities. The floor bucket gives you security. You know your bills are covered no matter what the market does. The upside bucket gives your money room to grow. Morningstar found this approach to be psychologically powerful because it removes the emotional panic of watching your stock portfolio tank. During retirement, you don't need to sell those stocks to eat. You have the floor. And when the market eventually recovers, the upside bucket is bigger than ever. The execution matters a lot here, but the framework is sound. The fifth strategy is the income floor, with systematic withdrawals. This is a variation of the floor strategy, but more structured. Here, you use a portion of your assets to purchase guaranteed lifetime income. Think immediate annuities or deferred income annuities to cover your baseline expenses. Then the rest of your portfolio is invested and withdrawn systematically. The guaranteed income piece means you can invest the remaining portfolio more aggressively in growth assets because you don't need to be conservative out of fear. Morningstar's research actually showed this hybrid approach can outperform pure systematic withdrawal strategies in terms of how much you can sustainably spend over your lifetime. The criticism is that annuities are complex, sometimes expensive, and you lose access to that capital. But for the right person, the guaranteed income floor is genuinely powerful. The sixth strategy is the rising equity glide path. Now this one goes against conventional wisdom, and I want you to really think about it. Traditional financial planning says you should reduce your stock allocation as you age. Start retirement at 60% stocks, then slowly shift to more bonds over time. The logic is that you want to reduce risk as you get older. But Morningstar's research, which echoes work done by other researchers, suggests that actually starting retirement with a lower stock allocation and gradually increasing it over time can improve outcomes. Why? Because sequence of returns risk is highest in the early years of retirement. If you start with a conservative portfolio and markets are rough in those first 5 years, you haven't sold as many stocks at a loss. Then as you get deeper into retirement and the sequence risk diminishes, you gradually shift toward more equities to capture growth. It's counterintuitive, but the data supports it. The seventh strategy is the proportional spending with adjustment rules. This is essentially a more sophisticated version of the fixed percentage approach. You withdraw a fixed percentage each year, but you layer in rules for when you'll adjust. For example, you always withdraw 4%, but never let the dollar amount drop more than 10% from the previous year, and never let it rise more than 5% above the prior year adjusted for inflation. These guardrails smooth out the wild income swings that come with pure fixed percentage withdrawals. Morningstar found this approach balances sustainability with income stability pretty well. It's a bit more mechanical to manage, but for someone who likes rules-based systems, it gives you structure without the rigidity of pure inflation-adjusted withdrawals. The eighth and final strategy is the dynamic income approach using actuarial methods, sometimes called the required minimum distribution method, or the present value approach. This is essentially what the IRS forces you to do with required minimum distributions after a certain age. You divide your portfolio value by your remaining life expectancy each year to determine your withdrawal amount. As you age and your portfolio changes, the withdrawal amount shifts. What Morningstar found interesting about this approach is that it's actually quite efficient. It's mathematically calibrated to your actual life expectancy, so it does a reasonable job of making sure the money lasts. The downside is that early in retirement, the withdrawals may be lower than you'd like, and the amounts change every year, making budgeting harder. But for people looking for a systematic, almost autopilot approach, it has real merit. So now that we've walked through all 8, what does Morningstar actually conclude? A few things stand out. First, no single strategy is universally best. The right approach depends on your income sources, your flexibility to cut spending, your risk tolerance, and your personal goals. Someone with a solid pension and Social Security doesn't need the same level of caution as someone whose portfolio is their only income. Second, flexibility wins. Strategies that allow you to adjust based on what the market is actually doing consistently outperformed rigid, set it and forget it approaches in the simulations. The 4% rule in its purest form, never adjusting regardless of circumstances, showed the most failure cases in stress tests. Third, the income floor concept is underutilized. Using some form of guaranteed income to cover basic needs frees up the rest of your portfolio to work harder for you. And fourth, starting retirement with a slightly conservative stock allocation and building it back up over time is worth seriously considering, especially if you're retiring in a high valuation, low yield environment. Here's what I want you to take away from all of this. Retirement income planning is not about finding a magic number and calling it a day. It's about building a system that responds to reality, protects your essential needs, and still lets your money grow. The people who run out of money in retirement aren't usually people who didn't save enough. They're people who withdrew without a real strategy, or they stuck rigidly to a rule that didn't fit their situation. Morningstar's research gives us a framework for thinking smarter about this. Study these 8 strategies. Figure out which one or which combination fits your life, and build from there. If this video helped you understand retirement withdrawals in a new way, please give it a like. It genuinely helps this channel reach more people who need this information. And if you haven't subscribed yet, make sure you do, because we cover this kind of deep, research-backed financial content every week. Drop a comment below and tell me,